You're 69 years old, married and retired, and you've just lost $600,000 in your 401k. Now you may be thinking a lot of things, but one thing we're going to look at today is should you convert some of this money from your 401k to a Roth position? Thank you for joining us. Hello, my name is John Vandergriff. I'm one of the owners and wealth planning team lead here at Blue Ridge Wealth Planners, where we help people create plans to transition effectively from their retirement year or working years to their retirement, or if they're already in those retirement years, making sure that they're not missing planning opportunities that can improve their overall situation. One of those areas that we see not planned for very often is the world of taxes and tax planning. And so we're going to dig into that a little bit today with a particular situation. And again, if you feel like maybe you've not been able to have a tax planning conversation that's really led to any action steps or any fruitful decision making, you'll see a link below here. I would encourage you to click that. You can schedule a time with one of our wealth planners where we can walk through a discussion very much like this with your details to see if some of these types of conversations we're having today could be of benefit to you. So with that being said, I always like to start off our videos with two disclaimers. First, if you like this content, make sure you subscribe to our channel, like the video so that we can get this out to more people, share it to those that maybe aren't benefiting from tax conversations out there. And then with that in mind, I always like to preface, don't act on anything here without consulting your CPA so that you have all the information on the table and working with a tax planning professional so that you can make sure there's not any things that are pertaining to your situation that we may not be covering specifically in this video. So with that being said, we're going to look at a 69-year-old couple have lost $600,000 in their 401k. Question becomes, should they look at doing a Roth conversion? And as we look at this, and we say all the time, it's important to make sure that we create what we call a plan for everything, but a strategy that's moving in the direction of the goals and objectives you have in the 5 areas of planning that we feel like need to be addressed in retirement. So income planning, investments, taxes, healthcare, family legacy. The video we're looking at today is actually going to combine these 3, where we're looking at not only the tax decisions today with the income, but also factoring in the investment losses that we may be incurring right now to see if that overall decision is one that leads to a Roth conversion. So a little bit more detail on this situation. Married couple, 69 years old, did have $2.2 million in 401ks 6 months ago. Obviously with bad market conditions, it led them to go down to $1.6 million in 401ks. So ultimately their net worth dropped from $2.6 million down to $2 million when you factor in their after-tax money that's between bank accounts and taxable brokerage accounts. But again, the good news for them is they didn't need anything from this from an income perspective, because between Social Security and pensions that they're taking, they've got $150,000 of income. Their income need is only $130,000. So again, they're able to weather the storm. That doesn't mean we do nothing. That just means that there's not an income need from the investment pool that they have at this particular time. So as we factor that in and we start to look and really zoom in on this situation, we see their income needs are taken care of. So with a taxable income of $150,000, that puts them in the top tax rate of 22%. So any discussions that happen about a Roth conversion will happen at least at 22% and then up from there, depending on how much conversion happens. And as we said today, pre-tax accounts at $1.6 million, after tax at $400,000. So, and currently 0 tax-free accounts, whether in Roth positions or properly structured life insurance, which functions in a very similar manner to a Roth position. All right, and so as we look at this, fundamental things we need to understand about Roth conversions: moving money out of an IRA, 401k, any tax-deferred position is a taxable event. And as we look at this, Roth IRAs need to be in place for 5 years before you have completely tax-free withdrawal potential from those accounts. The money's growing tax-free, but you need to have it for 5 years before the distributions are completely there. If you do those conversions under 59.5, you have to wait that full 5-year period to avoid a 10% penalty. If you do them over the age of 59.5, the principal that you convert will be available during that 5-year period, but any growth on that converted principal would be taxable to you if you withdrew the whole account, so, or more than you converted. So as we look at this, we always like to start with the fundamental question of, is a Roth conversion the right decision for me? And so what I'm going to do is outline an example here that looks at money in an IRA or 401k and really details if we left it alone versus if we took that money and moved it and converted to what we're talking about today, a Roth IRA position, which one is in your best interest? So as we look at this, obviously if we do nothing with it, there's no tax ramifications today. There will be some later when the government forces you to take this money out. But if we take it out voluntarily, whatever amount we convert, a little bit or the whole thing will be a taxable event for this tax year. And if the tax bite on that was 22%, as we're looking at with this situation, that means you would have $78,000 free and clear of taxes that would go into this Roth position if you did the tax withholding from this money. Now, you can take that tax withholding and not take it from this, but to look at the math between leaving it alone versus doing something, the only fair way to do that is assuming that we're paying the taxes out of this the same way we would be if you were taking RMD distributions in the future. So as we look here, 22% withheld. A lot of times advisors will look at this example and say, this is why you don't want to do a Roth conversion, because you're not going to grow as fast with 22% less money. Again, that doesn't really make a lot of sense because we're not comparing the same buckets here where this is taxable versus tax-free. So we've got to go further down the line and make these buckets equivalent. And again, we're assuming that we're investing these the same way for the same length of time. That way this truly is a tax discussion more than an investment discussion. And so as we look at this, some measure of time longer than 5 years from now, we are sitting here and maybe on the doorstep of retirement. We see that this 156 does not have a taxable event because we already paid the taxes and we've waited the appropriate amount of time. The IRA does have a taxable event whenever you pull those monies out. And what's interesting, if it is the same 22% at the time that you take it, it actually did not matter if you made the decision to convert this money or not. You've got the same bottom line in both scenarios. So as we look at this, if you felt confident that your taxes would never change, it actually doesn't matter which decision you make. Now, the general consensus when it comes to retirement advice is that we would be in a position in retirement where your income is lower than it is when you're working. And so if that were the case, then you would be in a position where you would actually be better off, as we look at the math here, if your income went from tax percentage went from 22% to 10%, you would actually have more money in the IRA or 401k by doing nothing because the cost to leave later is less than the cost to leave today. And that, as we look at this, is the thing that we have to evaluate for the families that we have these conversations with is now the time to pay the lowest amount of tax, or could that opportunity be later? As we look at things with most of the people that we're working with, sometimes their income will be higher later because of RMDs, or even if their income stays the same, there is a likelihood that those tax percentages could go up for that level of income. And if that were to take place, then the money that you leave in the IRA or 401k is going to be worth less than if you did the conversion today at the tax rate that's appropriate for you. So as we look at this, those are the decisions that we're evaluating for the families we work with, looking at income today, looking at where income will be later, and we'll start to factor some of those decisions in as we go through this video. But when you throw, let's say the math makes sense here to go ahead and do this, and then you have a unique opportunity where the market's at a loss, that can be an even better situation to do a Roth conversion. And, as we look at this situation, try to pay those taxes out of after-tax dollars so that you can get a good benefit out of the Roth conversion. So you say, well, what is it better for a Roth conversion to happen at a loss? Well, let's say you had $100,000 that was your particular stock, any stock you want, that was what it was worth 6 months ago. If you converted that stock then at a 24% tax bite, that would cost you $24,000 in taxes. If you're still holding the same amount of shares, but that stock goes down in value, it's now worth $74,000. you pay 24% tax at the 74 rate, you've paid a little over $6,000 less taxes, and you still have the same amount of shares. And so if the recovery in the market happens, which given enough time it will, then you've got a situation where your recovery will give you tax-free gain instead of a taxable gain back up to where the value was. So as we look at it, if the math is the lowest tax percentage and we get an opportunity to get more value of basically the share price for the amount of shares that you have, you can convert it there and have that tax-free increase. That creates an even better situation. And so as we look at the brackets, we've got to examine where are we today versus where could we be, looking at two different scenarios. So this couple with $150,000 of income at 22% would be their top dollar today. So any distributions out of an IRA would happen at minimum 22%. As we look at 2017's brackets, and I marked out to 2026 because if our current tax code expires, this is what we would be looking at. Taxes would jump for this particular situation from 22% to 25%, which doesn't sound like a lot, but for every $100,000, that's $3,000 of extra taxes that you would be facing. And then here, when it comes to 1981's brackets, and the reason we bring this up is because as you look at this bottom line number, 70% is your top tax bill versus the 39.6 in 2026 or 37%, but we see higher brackets just about every peg on the row here. So as we look at this, if this couple had $150,000 of income, they would jump to 37% if taxes got back to where things were in 1981. All these numbers, again, are adjusted for inflation to be today's money with standard deductions also inflated. So as we look at it, with $150,000, starting distribution tax would be at 22% versus 25%. And then if things got back to where they were in 81, 37, I think reality will probably be somewhere between these two for this level of income, especially long term. But as we look at this, we have to realize that this is not the only thing that we've got to factor in the decision, because this family will not stay at $150,000 of income if they do nothing. So again, the impact of RMDs is something that we have to take into consideration with the decisions we're making today. Even though this family is not at RMD age, 4 years from now they will be. So let's assume that since they're in a down position now, they have a quicker recovery. So we're showing a 6% growth on this money for the next 4 years. That would bump them over $2 million of 401k assets. If we take RMD percentage at that time, they'd be a little over $75,000 of RMD coming out on top of $150,000 of taxable. So that puts them at $225,000 of taxable income. And just counting what they are paying tax on today, their top distribution if taxes didn't change would be 24% versus a 28% bracket. So again, higher than the 25% we just looked at. And then in 1981 would jump from 37 to 49%. So again, you look at that number and say, how can I pay half of my income in taxes? Well, if you do a little bit of digging on tax history, this is somewhat low compared to where some of those brackets have been in the past. So the age-old question becomes how much to convert? Well, if we wanted to maximize the 22 and 24% brackets, which I would think for this family would almost be a no-brainer, especially considering that the RMDs that they're going to have later, they would be able to get $241,000 converted with an effective tax rate of 23.4%. But as we know, with them being 69 years old, 2 years from now, they're going to have an increase on their Medicare premiums that we need to factor into the cost of conversion here. And so as we see with their income going above 366 threshold, that would cost them an additional $10,000 in Medicare cost. So if we made this decision to convert, with the Medicare cost added onto it, the cost would be almost 30% for them to do this conversion. And so you may look at that and say, that's terrible. Well, 30% is a lot less than 37 or 49 and not much higher than 28. So as we look at this, the whole thing that we're looking at is if we make these decisions, first we need to know everything that goes into it. And then secondly, we've got to see if now is the right time to do it. And so if you've not had at least this much of a discussion with someone, you may be missing out on a good opportunity to make good decisions while we have these low tax rates. Because once they go up in 2026, I don't know when or if they ever will come down again. So, especially during the retiree's lifetime. So As you see this link below, click that. That will give you an opportunity to schedule time with one of our wealth planners where we can sit down together, go through in detail your situation, and see if this decision makes sense like it does for this particular situation. So thank you for joining us. Again, make sure you like and share the video that we have. Subscribe to our channel so that you can get more content like this. And look for a video coming out next week where, again, we'll be covering a similar situation, helping people in retirement make good decisions with their money. But as far as what we have for this week, that's all we have. Thank you for joining us, and we look forward to sharing more information with you later.